In this video, video 4, you are going to learn how to spot market maker accumulation, which will open up to getting in on the biggest and most profitable market moves. You will learn about the Great Deception more and how you can profit from it, and also form and content. Also in this video, watch out for the sequence of events that happen before every significant market move. Let's get on. Market maker's deception. Here are the tools. You can win big, it's easy, follow the rules and patterns, and the best part is it's all free. Now, whilst there may still be a few free things left in the world, trading the markets is not one of them. All this free has one single purpose: by getting you to follow a path of the masses, the path of the 95% that few will ever question. So why are you invited to the free money party? You're invited to the free money party because you're given basically you're given free data. How you're invited, you're given free data, free charts, free training, free indicators, and even free broker accounts where you can practice your trading skills and become familiar with placing orders. Why is all this provided for you? Because by following this path, you'll be heading to a destination that many traders never leave. The market makers have provided you with an easy to follow path that invites but basically places you in jail. That's exactly what it does. It locks you away. If your perception of trading is that you need the mechanicalized systems, you've got to have no emotion, all those things have got to be done, you've got to stand away from it, that will actually place you in jail. And what will actually happen once you're in jail, or after your 6 weeks, or obviously it can go on longer than that, what will actually happen once you're in jail and you've been starting to do all this stuff and you get a little bit more information, you're starting to develop strategies, what will actually happen, you will get into this, what I call this losing loop, okay? And the losing loop literally will start off that you will sort of have a bit of a strategy. You'll develop a strategy, you'll work out some moving averages, and if you don't know what a moving average is, if you're quite new, that's just basically some moving lines across your chart, and you'll work out when they sort of cross that then you should do this, will mean this, and then you should do that. So basically you will develop some type of strategy that will involve you or the chart showing you something and then you taking some action. And what you'll do is you'll play around with this strategy until you find that it produces a successful result. Of course, once you start getting the success, you'll likely paper trade this without any money. You'll sort of put it in, you'll back test it and find over years how this has produced a huge amount of money, and you'll become very excited about this. And you'll be ready to get into the market. And what you'll do is you'll then go live and you actually start trading this live. Now, generally at this point, what you've done is you've caught a cycle. You've identified a nice cycle. You'll start putting money in this. You'll go live and you may experience a couple of wins, a little bit of winning. And then what will happen is you'll discover that this actually starts to failure. So on paper, this looked very good. Everything worked very well. But we actually start getting into failure. It starts losing. You start losing a bit more money. The cycle starts to change. Then what happens is you then develop. You go back into what's known as the development stage. Now, the development stage is where you go back to your original strategy and you tweak it. You mess around with it. You adjust the parameters. What you do is you adjust the parameters and you convince yourself, yep, this is now good. You're back at the strategy development phase. This is now good. I'll now back test this. I can now see over so many years this has produced X amount of money. You'll see it experiencing success, and once again you'll go back down and you'll start going back in, going live. I don't need to go any more from this. Once again you'll go back into the failure, back into developing, back into strategy, and so you will get caught up into this losing loop. Now, how long can this go on for? I have met traders who've been trading in excess of 10 years and they are still in this loop. They will openly admit they have developed thousands, literally thousands of trading strategies. They've become highly educated over the years in technical analysis, all sorts of information like that, but they are still in this loop, going round and round, this endless loop. It's a bit like, I say the definition of madness is to keep doing the same thing over and expecting different results. This is exactly what we're faced with at this stage here, getting into this losing loop. You need a get out of jail card. And the get out of jail card is what these DVDs are about. The get out of jail card is understanding and trading the market makers 3 phases. Now, most of this DVD course we're going to be talking about the three phases, because this is what this is about. By understanding the three phases of the market, as you'll get out of jail card, you are going to break that the cycle that we looked at on the previous slide there. And the three phases are: we have the setup, the setup phase, we have an accumulation phase, which is sort of linked into there, and then we have a profit release phase. So just recapping on there, we're going to understand the three phases the market makers, the business makers model, and the three phases of that model. Form and content. In order to understand the model, we need to understand the difference between form and content. Now, we'll be returning to form and content many times, and the reason for that will be we need an exhaustive explanation into this topic, because understanding this, truly understanding this, will mean results varying from great success, mediocre, or basically failure. Now, given the difference between those results, you can hopefully see why I'm placing so much emphasis on this. Now, form is the shape of the chart. Form is the pattern you see on the chart. Form is a single bar that makes up the shape and the pattern. Now, content, on the other hand, is what is contained within the shape of the chart, within the pattern, and within the single bar. Now, this is not an easy thing to understand at this stage, because after all, how can you understand the content if you can only see the pattern? Well, don't worry, because pretty soon you'll understand the market maker's business model. And when you do, you'll see that the content in any chart that you look at. Not only that, but you'll also know how to interact with that content to achieve a profitable outcome for yourself. Now, taking form and content one stage further, we can say that the form of the chart gives us rather a facade. It places before us a facade on our screens to mislead us, as opposed to the content, which is the true reality of what is going on. Reality and the facade. Where does this lead us? If we trade reality rules and we trade facade rules, really, what we're going to be looking at, we're going to be looking at patterns. These patterns, I said about the higher bar here and the lower bar there. We're going to be looking at the patterns on the form that's presented to us, the facade, the form of the chart there. We're going to be likely to have bar names, and you know, somebody gave me a book a few years ago and on candle chart names, so you see a particular candle shape on a chart, and some of them are just wonderful. Morning cloud over, Hirami cross, engulfing bar down, and these are as if they're meant to mean something. And you know, we can find these patterns and we can put them onto a 10-minute chart, and we see this beautiful pattern that's illustrated in the book. And I said, that's fine, that's great. Now, what happens if we move to a 15-minute chart? That pattern's gone, but another pattern's there. And then you ask, well, you know, what's going on? Which time frame do we trade now? Are we trading 10 minutes a day, the 15 minutes a day, the 20 minutes a day, the hour? What are we doing? What are we trading? And of course, none of these make any sense, because these are the form that's presented to us. And when you think about it, what is the market? The market is not segmented. It's a constant stream of ever-changing ocean, if you like, a constant changing stream of information coming through in terms of prices. And we'll start to develop popular indicators. You know, just go to Google, type in what is the most popular moving average, and you'll find out whatever that is. Oh, I don't know what that is, but you'll find that. And so you'll start trading these popular indicators on there, and you'll be listening to truisms. You know, truisms. Trade with the trend. The trend is your friend. The great things, they sound like they should have meaning, and in one respect there is an element of meaning in them, because you know, when we talk of a trend, I'm talking of a profit release. The outside is talking of a trend. Think about that. I'm doing profit release, trend, the same thing, but it's how I view the market. It's a profit release, it's not a trend. Trade the trend, that sort of thing. These are all truisms that traders can get hooked up on. And of course, this is the form. If we trade reality rules, the content, very simple. Very, very simple. We're going to be trading the market maker's business model of making money. We're simply going to be working out how are the market makers making money from what is being presented to us today on the chart. Once we understand that, we will make money. It's as simple as that. We don't have to have all these indicators, all this time frame lines. We don't have to do it. All we have to do is do this on here. So what is behind every market move? Of course, every move must start somewhere. Looking at the form of the chart, the facade, that start will be seen to begin from the most recent high or low on the chart. This not only makes logical sense, but there it is right before your eyes in the form of a pattern. However, the market makers are a profit-driven business, and as such, in order for the market makers to make money from any move, they will need to accumulate either buy or sell orders depending upon which way the market is going to move in the future. What we can draw from this is that if we can understand the process of accumulation and the completion of that accumulation, we can identify the true start of any market move. And I'm sure you can now understand that just how profitable that can be. So accumulation of the buy or sell orders. If the market makers want to accumulate buy orders and everything is matched in the market, so if I buy, for example, somebody else is selling, so we're selling, we make that exchange, and if I sell, somebody else is buying, everything is completely matched in the market, okay? So let's suppose that I want to buy something from you, I've got to convince you to sell it to me. And if you want to buy from me, you've got to convince me to sell to you, okay? So this thing here is conveniently matched well is vital to understand. There's no load of buys here without sells. It's all completely matched. So in order for the market makers to buy, someone has to sell. Very, very important point there. Very important to keep that in mind. Someone has got to be willing to sell. Now, why somebody be willing to sell when the market makers are buying is a whole different thing, but we'll get to that in a moment. Okay, and if of course the market makers want to accumulate sell orders because they anticipate or they know that the market is going to go down and they want to accumulate sell orders to profit on the way down, who's buying? They've got to convince someone to buy. Now we hear a lot of traders talk about the market's overbought or the market's oversold. That's a complete fallacy because everything is matched out. Nothing's ever overbought, nothing's ever oversold. There's only people's beliefs about whether they're willing to buy or whether they're willing to sell. They might have stronger beliefs one side of things, but everything is going to be matched. Okay, so the process of profit is, in order to make profit, you've got to, if you're going to buy something in and sell something out, and you want to make money in that respect, so in other words, we buy and then we sell at a higher price, we've got to be able to accumulate. We've got to have something first in our possession to then sell on. Now, a little bit difficult to explain in some respects, especially with the sell side, of course. When we're speculating on markets, and we're talking about the forex market here, but any market indeed, when we're speculating on markets like that, unless we're actually physically buying shares, accumulation of shares or stock, we don't actually own anything. Nothing is actually given to us in paper, as it were. Now, we are really just speculating on price difference between now and what it might be in the future. Is the price going to be higher, in which case we want to speculate on higher prices? Is the price going to be lower, in which case we're speculating on lower prices? People have a job getting your head around the short side or the sell side, but we'll go through that piece by piece to make sure you understand that. But basically it is a mirror image of the upside. Okay, so in the process of profit, we've got to buy something. Now we touched on accumulation. So you've got to accumulate something, okay, to then sell later on. So in our case, what we're actually accumulating, think of it as buy orders. And if you want to physically give it something, think of it as slips of paper. You know, just think of anything that'll put it into your mind as an image. We need to accumulate what's known as buy orders. If we're going to accumulate buys to sell later on and profit from those at a higher price, we need to accumulate buy orders which will sell later at a profit. Likewise, if we're going to sell the market, we think the market's going to go down in value, we want to accumulate, we still want to accumulate, we want to accumulate sell orders. In other words, little sell bits of paper. That's what we want to accumulate. So we either accumulate buy orders or accumulating sell orders. And this is the market maker's model, remember, not us. We're doing the same sort of thing, but I'll get to that later on. So you're either accumulating buy orders or accumulating sell orders. The market makers are. In this case, they're selling to buy. In this case, they're buying to sell. Okay, now so you've got to, so we understand that we've got to have that accumulation, we've got to have that stock before we can do anything from there. Okay, the sequence of events that market makers run through are very simple. It's a simple business. And now I hasten to add here, when I say it's a simple business, the market maker's business model is a very simple business. It has to be. You couldn't run something as complex as the financial markets with a complex system that was liable to break down or whatever. the actual process of making money with the market makers is this very simple three-stage process. Now, in the acts of buying and selling, we actually have what is called an accumulation phase. Now, you can see I've got ACC up here. I've just shortened that to save me writing out accumulation right the way across the board there. So we've got this accumulation, and this is one of the phases here, this accumulation phase, which is the first phase of the cycle of events. The second phase is manipulation. And the third phase is the profit release. Now, I will be breaking all these down for you piece by piece. So first off, we've got to go through this accumulation, understand what this is, we understand what the manipulation is, and we understand what the profit release is. When we understand these three phases, and we can identify those three phases, we can join the market makers business model. In this section, we looked at the trading jail, how you get in there and what happens when you get caught up in the cycle of strategy development. We looked at the tools and methods of the trader, also a section on the facade of the market and versus the reality, basically. The accumulation of buy and sell orders, the process of profit, and finally the sequence of events. It was a lot to take in, but you can always recycle through any topics if you need to, and the markets are not going anywhere without you. Time spent in study now will pay great dividends soon enough. We're going to start off in this next section with the market makers business model. Basically, a very, very simple business model. They need accumulate, again I've ACC just to shorten that up, accumulation. They need to accumulate to sell higher. Okay, they need to accumulate to buy back lower. It seems like a sort of a confusing thing when you read this through. So just have a think about that for a moment. And that's nice and easy to understand. Accumulate to sell higher, so you get something in to sell it higher, or they need to accumulate to buy lower. It also doesn't make sort of sense, but it does make sense because that's how the business works. You accumulate something to sell at a lower price and buy it back. You buy it back at a lower price, and you've profited from the price difference. So, okay, so basically we can see that they create a circle. There is a circle of selling and there's a circle of buying. Now, you might think that I've written these in the wrong places because is buying down, selling up. It doesn't sort of look right as it should be, not as in our minds. Now, that's because we're now viewing this as a market maker's business model, not our business model. If it was our business model, we need to be buying on here and watching this rise up. But of course, we're looking at the market maker's business model, which is what we're going to be trading. Now, in order for the market makers to make profit, and they need to sell at a later date, when the prices are falling down, or manipulating this down, they need to be thinking about buying through this period here, ready to sell back in here. Now, we'll get more into this part at the moment, but of course, as they're selling into there, you might say, well, who are they selling to? Well, of course, they're selling to the outside masses who are actually seeing the market start to go up, and they're releasing or selling those buy orders that they bought earlier, and so they release profit. Now, I've only just touched on that at the moment. We'll get that fully covered as we get later on. And the 95% of traders out there, the 95% that we looked at earlier, they are fueling, or they are part of the fuel of this cycle. And of course, throughout this cycle, we have there the word manipulation. This is all being manipulated as well. Accumulation and profit release cycles. An often asked question by new traders is, when is the exact moment to trade, or what bar tells me when to trade? And hopefully, even at this stage, something along the lines of form and content will start to be going off in your mind. But of course, you do need to know when to place that trade. We do need to know what time we are presented with a low risk, high reward trading opportunity. Now, discovering this time has to do with accumulation and profit release cycles. Now, here in this example, you can see we have some nice circular movements of rising and falling stock, which, like in the previous slide, are representative of the cycle of accumulation and profit release. However, perfectly formed cycles like this are unreal because they do not take into account time or price. Let's now have a look at some more realistic, let us say, cycles. This is a much more accurate representation of accumulation and profit release cycles because now we've added in time and price as shown by the X and Y axis. Examples A, B and C are all still cycles, but they are distorted by this time and price. In example C, we can see that the accumulation periods at the top and bottom are elongated by time, and the profit release phase at the sides only results in a small rising and falling of price. Compare this to example B and we can see that the accumulation periods were completed quickly with then rapid price increase and decrease. Of course, this is an oversimplification when compared to a real stock, as one might end up with very odd shaped circles indeed. But this does explore time and price as contributing factors on when the trader should buy and sell. Okay, we've reached the point where we need to look at how you're going to succeed as a trader. You're going to succeed at trading in a two-stage process. First, you'll need a thorough understanding of all phases of the market maker's business model. You'll need to observe this model over time and to build experience with it. You'll then need to identify when the model is in a particular phase. At this stage, it can be said that you will be reading the market, not the form the chart takes rather, but not the patterns of course, but the content. You'll be reading the content of the market. Now when you can read the content, then you can move on to the second stage, which is interacting with the market maker's business model. And at this stage, it is you that have your required business model. This is going to be your business model. Well, that was a big one. You learned some powerful trading concepts in this video, and now you are over the hill. It's downhill from here. Now we start putting all this together into a strategy or method that will light a fire in your belly. In the next video, video 5, you will learn how to interact with the market maker's business model. You'll learn how to spot fake moves, and you will learn about the setup for buying and selling. This next video will almost certainly be your turning point towards profitable trading.